Brilliant. Well, thank you all for joining. Thank you for giving up a bit of your Wednesday to listen to accountants. I know that's quite a sell, and so obviously you have done a good job of upselling what we can offer you today. I'm Andrew Douthwaite. I'm a partner here at Alliotts, and I lead our gaming sector team. Sarah, do you want to introduce yourself in that non-awkward way?
Certainly. I'll try to be non-awkward. No, my name's Sarah Messruther. I'm a senior tax manager here at Alliotts. I'll be talking about tax.
So today we're going to talk mainly around the startup world, although there could well be elements that don't apply to the startup world, but really that's what I focus on as a partner. I work with early stage and high growth businesses who are either seeking investment or have just had it. And now I'm going to try and share my screen, which worked perfectly off of camera, but now no doubt will have some form of issue. And hopefully that's working for everyone.
Yeah, looks good to me.
Perfect. And as we discussed earlier, we have off camera, we have some characters on every slide. So even if you find me and Sarah incredibly boring, we do have a character on every slide. If you can work out who each of them are at the end, there's no prize, but at least you'll have got something out of this. Before we get cracking on the exciting stuff, a quick disclaimer that I was forced to put in by our compliance team. So this presentation is provided for general information purposes only. It does not constitute legal, financial, tax, professional advice. No reliance should be placed on the information contained herein without seeking independent professional advice relevant to your circumstances. While care has been taken in preparing this material, no representation or warranty expressed or implied is made to as to its accuracy or completeness. The presenters and their organisation accept no liability for any loss related to this material. Lovely. That basically means if you want specific advice, come to us or your professional advisor if you already have one. And this is really just for general information. Right, compliance over. A bit about Alliotts and what we do in the gaming sector and really in the in accountancy. So historically, if you'd have asked me about a year ago who we are, I'd have said we're 100 people based in London and Guildford. Well, that changed last year. We're now 600 people as part of a group with 15 different locations and 55 partners. As I said, my focus is really tech-based startups up to Series A, which gaming sits within that. And we provide anything from your traditional accounting services to more integral services, like for a number of clients, I work as their sort of fractional CFO, so helping them fundraise, getting more ingrained in the business. And Sarah on the tax side and with our specialist tax team, they deal with your creative tax credits, so VGTR, VGEC, and much, much more. We sponsor the London Games Festival and Guildford Games Festival. I actually have just assisted the London Games Game Changer Accelerator program. I did a very similar talk to them about the things we're going to cover. We're Yuki members, and just so you're interested, the last game that I finished was Expedition 33, which with a 6-month-old was actually quite challenging. But actually, with a baby, I did learn that I got through quite a few good games while they were less mobile, whereas now I don't really get the chance. In terms of what we plan to cover, so I'm going to cover some financial language and key terms. The reason for that is a number of startups and early stage businesses, I find they get totally bewildered by the language that accountants, VCs, PE, and other investors use. And sometimes that makes them feel like they don't understand what they're asking for. And actually, a lot of that language is just hyped up and really unnecessary. I'm also going to talk about basic financial hygiene for startups and why it's important and what it actually is. And then a bit about budgets and forecasts, particularly for clients who have gone for investment or are going for investment. It's knowing the difference between the two and how to build one, as usually that is a key part of what investors will be looking at. And then Sarah, on the more interesting sort of tax side, is going to go through VGTR and VGEC, the creative tax release, a bit about R&D, and then finally some on share schemes, and then we'll open it up to Q&A. However, if you do want to ask questions throughout, please just interrupt because we're going to cover a lot of ground very quickly. And usually if you ask all your questions at the end, we may have lost the context of what you've asked. So it's much better to interrupt and it won't be taken against you. Well, so key financial terms. These are the ones that from talking to clients, from working on accelerator programs, these are the ones that people get tripped up on and don't tend to be able to explain or understand. If you imagine sort of a dragon's den being asked by investors, what's this, what's that? These are the terms that people have struggled with, and I've helped them understand. So gross profit margin. So this is your revenue minus direct costs. So in the gaming sector, if it would be your game sales, take away, say, your distribution fees, your royalties. If you've got a live service game, it might be your sort of server costs, and that margin shows your profit after your direct cost of sales. EBITDA is a key term in the investment world because that is really how a lot of businesses get valued, and that's your operating profit after accounting for taxes, interest, depreciation, and amortization. So what we're doing here is we're stripping out all of the non-trading elements and just sticking with what is the business in the core actually generating as a profit. And what you'll find is that when people talk about valuations of businesses, they're talking about a multiple of EBITDA. And that usually depends on really how large it is, what the growth rate is, and also the sector. Net profit, so that is where we go all the way to the bottom after sort of your costs, all of your overheads, and it's usually after tax as well. And then cash runway, really important in the investment world. So if you've got a startup and you're looking for investment, how many months is that cash going to keep you working? And you're typically determined in months. So how much months of runway do you have if no new funding comes in? On those key performance indicators and metrics, so one of the ones that got added to this presentation from a client was, I keep getting asked what my CAC is. Well, customer acquisition cost is how much it costs in sort of your advertising and your marketing to get a new gamer or to buy a game. So how much does it cost you to bring in someone to buy your product or buy your game? For customer lifetime value, or LTV, that's how much over an entire, say, game or life a customer that is, sorry, how much over a customer's lifetime they're going to spend. So if you have someone on a game and they're buying the game up front, and then they're buying, say, DLCs, they're buying season passes or in-app purchases, it's all of that spend over their entire sort of lifetime as a customer. Cost per click, particularly in gaming, in mobile gaming. So that would be the price that you pay, that is paid by you every time a player kicks on a game ad. So things like Google, Facebook, Twitch. How much do you have to pay for that advertising to bring that person to your game? Then on to revenue per user, and there's two different variants of this, particularly with the sort of influx now of sort of free-to-play games. So you've got average revenue per user, which will include all users, whether they're paid or not, and then average revenue per paying user. So that's focusing only on those who spent money. Useful metrics, particularly in the VC world, as they do look at that. And retention rate is another one. So if you've got someone who plays your game on day one, how many of those are still there on day 7 or day 30? And that churn rate is that percentage at which they stop playing or uninstall the game. And then finally, conversion rate on the KPIs. So that's the percentage of players who take the next step. So they upgrade to, from free to play to premium. They subscribe to a battle pass, or they pay for additional content. Finally, the stage of business life. This is something a few startups have sort of asked me to explain, so I thought it'd be useful here. People talk about these in terms of investment, so whether they're pre-seed, seed, Series A, and then it moves on Series B, Series C, and so on. Pre-seed is usually when you've got, say, a small development team and they're prototyping game. They might not have even built anything yet. It's just an idea at this stage. Whereas your seed funding would be when you're building and testing that first release. And then Series A and beyond is usually where you've got the product and you're now scaling it. So you're looking to grow the player base, hire more people, and then expand to perhaps different markets or consoles. Covered a lot of ground there. Is there any questions on this slide in particular? Because I appreciate I rattled through it quite at speed. And I'm not sure I can actually see the questions because I'm sharing my screen. Nope. I will move on. Financial hygiene sounds a bit dirty, but actually what we're talking about here is do you keep your records and your finances in check? And why is that important, particularly for startups? Well, I work with a lot of them, and ultimately a lot of startups are concentrating on the product, which is important. the finances aren't always the number one priority for an early stage startup, and that makes sense if you're building something new. But when you reach that need for investment, we have a number of people. In fact, we're working with 2 or 3 at the moment where they've reached the point that they're about to get investment, and their record keeping is such a mess that they actually need to pay a lot of money to get them in order. And so when we talk about financial hygiene, it's do you keep it in check? And a bit like brushing your teeth or tidying out your garage, if you don't do it for months and years at an end, it's a lot more work at the end. So why is it important? Well, like I said, it's losing credibility with future investors. Are they going to look at your records and go, well, these people aren't serious business people? For founders, it's losing that sight of sort of cash runway. Have I got enough cash to keep the lights on? It's the fear of the unknown, and this is sort of the one that people don't realize is if you're not tracking your costs and your cost base and your cash, a lot of it is psychological in that you're not actually sure where you are, and that isn't a great place to be for a founder, particularly if you've got employees. And ultimately, it does tend to lead to a large bill for someone else to fix it up if you're not able to. As hopefully, if you're a successful startup, there will come a point where you won't be able to do everything, including your own bookkeeping. So, what does it look like for a startup? Well, for me, it's not about doing it every day. So if you're thinking just because I'm an accountant, I'm going to say you need to have your accounts perfect every day. That's not the reality. But I think it means having your bank reconciled at least monthly with all of your costs analysed out, and those outgoings, looking at them monthly. And if you have any regular suppliers, if say you're using contractors or subcontractors, just having a look at them on a quarterly or annual basis to make sure that you're still paying the right amount and you're competitive. Things like your insurance, things like your regular annual costs that even your accountant, for example, making sure that you're appraising that cost and make sure you're getting the best deal. If you're VAT registered, they should be delivered on time every time. It's a typical disclosure that you'd have to make to investor if you've missed a deadline. Always having an up-to-date cap table. So by cap table, that's the list of everyone who's got share capital in your business. So if you've had investors, it amazes you to hear, but there are a number of startups who don't track it. And when they have to make a filing at Companies House for their confirmation statement, it then becomes a great bit of fun for us to work with them to work out who's invested and what the names of all of them are. An investor will not be particularly pleased if you don't have that to hand. It's make sure your year-end accounts and your corporation tax are filed on time. And this isn't necessarily, I say it isn't necessary. This is, to me, a necessity, but other people might disagree. All of your costs and income having the backing for it. If you're not using an accounting system in a shared drive somewhere that you can easily access, password protected, of course, or in your accounting system like a Xero or a QuickBooks or whatever it is that you use. Now that to me is, if someone's doing all those as a startup, they're in a good place for investment, and I think they would see the benefit of doing that. Now, how can you do it? Well, we work with a lot of tech. One of the things at Alliotts we've pushed on is using as much sort of up-to-date accounting technology as possible. And this is a typical tech stack that we work with our clients on. This is a typical tech stack that we're starting to see a lot of others use. So Xero and QuickBooks, they're very similar, but at the moment our sort of preference when we're using one is Xero, just because we've got more clients on that. Xero will handle all of your bank feeds, so you don't have to upload a statement. You don't have to do massive analysis. It's very intuitive for non-accountants to use. You can do your VAT filings. You can even prepare accounts and corporation tax through it now. You can even do your payroll through it. So as a core accounting system, it covers a lot of what any startup would need, and the costs do depend on how big you are and how complex you are. So it can range from sort of £20 a month up to about 50, depending on whether you're multi-currency. But it does offer a lot, particularly at the early stage, if you're trying to keep costs low, if you don't want to pay someone else to do your payroll, for example. Either side of it, we've got, on the left-hand side, we've got these inputs. So invoice processing, if you have large quantities of costs that come in, one of the pains that many founders hate is doing bookkeeping and typing in onerous things into their accounting system. Well, these two softwares sort of negate the need for that. Both are what we call OCR software, which it just takes an invoice, takes all the data off it, and then allows you to push it into Xero or an accounting system really quickly. Briefcase is a lot more AI powered. It's a lot newer. and it can actually help with determining some of those tricky VAT treatments, and it actually explains to you why it's done that. And so both of those can remove a bit of the bookkeeping work if you're having to do a lot of onerous work. And then Fathom on the right hand side, it's really something that we use with our clients and particularly with VCs and private equity, which is it provides management reporting and enables us to give a glossy report that's not really just for accountants. So we can track all of those KPIs that we talked about earlier on in the presentation. We can show that all in a much more colourful, meaningful way for investors, so that again it breeds that confidence that their investment is sound and that you are as a business you're taking your finances seriously. A couple of other elements that we have used and currently use. So Apron, if you operate a large payroll, if you have lots of suppliers, it's a pain in the bum having to pay everyone. Apron, it takes out of zero. You make one payment for all of your suppliers or all of the people on your payroll, and Apron takes that data, as long as you have all the bank account information, splits it and backs to back it and fires it to everyone at the same time. So from your perspective, you authorize the payment in Apron and it has approval procedures, but actually it means you only have to make one bank payment, not several, which for some of our clients who operate large payrolls really is a massive time save. For the clients who've had investment and are sat on excess cash because they're not needing it all at the same time, one of the challenges we have is treasury management. So how to keep all of that cash and those spare funds sort of across all of the bank accounts that they want to safely with the FCS limit. And so what Round Treasury do is it allows you to do that with opening one bank account rather than multiple. So if you imagine you get £1 million of, say, seed investment, and you want to spread that across as many bank accounts as you can, so that it's all protected, but also to get interest on it, so that you have a bit more cash. Round Treasury allows you to do that in a much quicker way, and they don't charge for the platform; they charge based on the interest that you've gained on your deposits. So, really, really good startup themselves, who themselves have had VC investment quite recently. And then finally, Dex Precision. We talked about Dex earlier. That was the prepare method, prepare version, which is purely for invoice processing. Well, this looks at all of that data and then using algorithms works out if there's a risk for inconsistencies or errors, particularly useful on the VAT side. Very easy to get, say, entertainment sort of mixed in, client and non-client, and it will spot that. I think someone's asked a question because I saw a notification, but I can't see it. Here we go.
No worries. It's the question here is asking whether it deals with challenger banks. I don't know quite what
Yes, it does. So it looks at the whole market. So it's not your typical lenders. I would really recommend you looking at them. If you want introducing to one of the founders, he can sell the platform a lot better than I can. And we've referred a couple of clients to them, so he can explain sort of the different banks that they have on the platform, but they go beyond the traditional lenders. So if you're talking about, say, like a Revolut and people like that, depending on how they operate their deposit accounts, yes, I'm sure. Lovely. No problem. Okay, before I jump on from accounting tech, does anyone have any questions on that element?
We did have one a little bit earlier on about
Oh.
the asking about the trading costs you mentioned when talking about EBITDA. This is something that I'm not clear on. So
Okay, sure. Let me go back.
Yeah.
When you're saying trading costs, was it the definition of EBITDA? Was that what we were?
Yes. Yeah. Essentially. Yeah.
Okay, I'll try and explain it again, and maybe I missaid it. So EBITDA is when you're really trying to strip out anything that's an accounting adjustment or a finance adjustment. So that's what and tax adjustment. So we're stripping out everything that's sort of non-trading, non-core. So what we're left with is really those core admin expenses of the business after your gross profit margin. So gross profit is our sales less our direct costs. And then we've got all of our admin expenses. So that might be your staff salaries, it might be your premises costs, your sort of light, heating, electricity. If you've got, in the gaming sector, you're going to have things like your server costs, all of those expenditures. So that would be our EBITDA after those costs. After that, you would get to net profit from then doing your interest costs for any sort of loans or any interest income on your deposit accounts, which aren't trading. That's non-trading income and non-trading expenditure. That's for financing the company. So that's what I mean by we're stripping out anything non-trading, and EBITDA is really trying to get to the core of the business and work out what that profit is. And as I think I said earlier, the reason that's used as a valuation metric is we're looking at that core business and then we apply a multiple to sort of work out what it's worth, which depends on sector, depends on size, depends on a number of other sort of things. Is that all right?
Yeah, I think that makes a lot more sense. Yeah, I really
Real.
appreciate that.
Second time's the charm. My bad. Right, budgets and forecasts. Why am I talking about this? Well, it comes up quite regularly because a number of early stage businesses get asked to do a forecast by potential investors, by people who are interested in them. First off, what's the difference between a budget and a forecast? Well, typically a budget is 12 months. We're looking just really at the next year, whereas a forecast is up to 5 years, 3 years being the minimum. A forecast is made of 4 different things, usually. Can be a lot more, can get really complex. Some of the financial models we've built are pretty strong, but this is like the bare minimum. So a list of assumptions, so all the things that you put into it, your profit and loss account, which we've sort of talked about earlier with sort of going all the way down from sales, EBITDA, etc. A balance sheet, which typically is where it goes all wrong when people who aren't accountants are building a forecast. And then a cash flow statement, which is just showing those cash flows, which again, if your balance sheet is wrong, your cash flow statement will be wrong. But why do we do them, and what's the point of them? Well, for investors, it's credibility. Do you know where this business is going, and does it actually look sensible? From a risk assessment perspective, if you've got a VC, they're interested in people who are going to make them 100x return. So if you're not predicting that, they're not going to be interested in investing in you. Now, will they actually believe a forecast? No, probably not. But it shows that you can build one, and it shows an idea of where you're intending to go. And for you as founders, it's that accountability. It shows what the end goal, and it hopefully means in your head, can you actually see it happening? So it's a useful thing to do, even if you're not going for investment. Regular issues that I find with clients who've done forecasts. They miss the assumptions list. So they build everything. It looks wonderful. They've got a balance sheet that balances, fantastic. But they can't actually tell you quickly how they got there. So why are sales this in year 2? Why is cash collected a month after a sale? Why is cash collected in the same month? Why are your costs this? Why are the costs paid then? Everything has to be listed out so that you have the audit trail so you can explain it to someone else. The classic balance sheet cash flow doesn't balance, see it all the time. Scenario planning, so that is where, have you got a best case, worst case scenario, as well as sort of what you've already done. Have you included tax impacts? So have you thought about any tax relief claims, particularly if you're planning on claiming R&D or VGTR or VGEC? Have you thought about seasonal variation? Obviously in gaming that's probably a bit more challenging, but around Christmas time you might expect there to be more discounts or something like that. Have you thought about inflation? And then hockey stick sales. So this is where you go from nothing to everything, which actually in gaming happens, but it doesn't mean people like to see it in a forecast. So it's having something that's sensible on the sales side that you can sort of point to something and say that's why it's that. On those assumptions, so helping you sort of build an idea of what you would put into a forecast. So if you've got sales and direct costs, more than one product or service, don't forget to split them out. People want to see the different revenue lines. So if you've got more than one game or you're making multiple at the same time, you probably want to see what the revenue is on each of them. And then the timing. So if you're going through, say, Steam, or you're going through a Nintendo store, the payment sometimes comes all in a bunch later. So have you considered the timing of it? You're not just going to get paid immediately when the sale occurs. And then those direct costs. So depending on what you do, I know it's not just studios that will be on this call, but does your business have those direct costs that you would attribute straight away? Do you have to pay commission to anyone? Do you have any royalties? And then again, try to avoid the hockey stick projectors if you can, but we're all aware that there are things like sort of Power World that just suddenly come out of nowhere and just make millions in a month. It does happen in gaming, but that doesn't always feed brilliantly into a forecast for credibility purposes. Admin expenses. So are you as a studio going to have premises, or are you going to be fully remote? We're seeing a lot more of that now. What staffing headcount do you need? Are you going to need IP and legal fees for patent protection, paying people like me and a consultant? And again, when are all these people going to get paid? These are all the assumptions that you need to build into a forecast. I said one of the classics is a balance sheet not balancing, and one of the questions I got when doing a similar presentation a few months ago is, what do you actually mean? Well, this is what I mean. So do your net assets agree to your total equity on a balance sheet? If they do, it balances. If they don't, something's wrong. But all of those assumptions at the end have to come together and work. And again, one of the things on the balance sheet is, if you're looking at raising finance, are you planning on raising pure debt or equity, or a bit of both? And again, if you need help with something like that, or you've got questions about that, feel free to sort of message me after this presentation. One of the things we talked about earlier was Fathom, which provides management reporting. Well, it actually has a forecasting tool as well, which is probably easier than someone who's not an accountant using Excel. I've yet to break this. It does have limitations, but it is pretty unbreakable. If anyone wants to challenge me on that and try and break Fathom, I'll be fascinated to see how you did it. But it allows you to do a forecast using your live zero data. It pulls it all through, allows you to build assumptions on top, allows you to build scenarios on top, and then see the impact of things like hiring a member of staff, taking on premises, and you can then see on your cash flow the impact that will have based on what you expect to do and your expected inflows and outflows. So it's a really helpful tool if you're wanting to use something and not having to build sort of an Excel model. And I think that's over to you, Sarah. I think hopefully everyone's still awake.
Don't know whether to pause for 30 seconds and see if we get any questions on anything from your side. But otherwise, yeah, I will take over then. Andrew suggested this was the more interesting part of the presentation, so that's fascinating. I don't think anyone's ever accused tax of being interesting before, but who knows? Oh, there we go. Question in, does Fathom deal with shares, Andrew?
Sorry, can you confirm what you mean by deal with shares? Do you mean, can you put in investment and see the impacts of it? You don't get a typing thing on Zoom, did you? If people have shares and dividends, you can put that in, yes. So if you've got an idea of how much you're intending to pay as dividends, you can put that into Fathom and see the impact of that on cash flow, etc. Yes, you can. And if you do actually decide to, I think you can get a free trial for Fathom, although that was, it was a while ago. If you do want to play with it, and then if you do have any questions, I'm happy to sort of do a free walkthrough of that with you, or show you just how you can do it. No problem.
Fabulous. Okay, yes. So on the tax side, going to talk about 3 items. I do apologize. Someone just rang me. It went straight through my headphones. 3 items I'll be talking about, really 3 areas of tax. One is video games tax reliefs, obviously the most specific of the tax areas, really. And then moving out a stage, go to R&D tax relief. So R&D is research and development. And then stepping out again from the investment side, then we're looking at share schemes, specifically from the investment side. Next slide, please. Thank you. So the 2 video game specific reliefs are VGTR and VGEC or VGEC. So video games tax relief and video games expenditure credit. So the reason these were introduced, as far as I can fathom, is that obviously development on a video game is not very straight line, especially from a cash flow point of view. It's going to be quite lumpy. You'll have a lot of outflow first before you then start making any kind of income. So the aim was to give additional reliefs in that expenditure heavy stage of the production. So VGEC is replacing VGTR. That's why there's two of them. VGTR was the first one and VGEC's now coming in. Which one you use depends on when you started your development. So if production starts before or started before the 1st of April this year, you can continue using the VGTR scheme for another couple of years. But if production started on or after the 1st of April, then you're using the new scheme, the VGEC scheme. Next slide, please. Thank you, Slide Master. So there are some differences between the two schemes, and these are kind of summarized here. So VGTR, the tax relief, that covered EEA and UK costs. And that was because, this was a kind of pre-Brexit idea. So to be fair, it covered all of the European territory as well. And then VGEC as the new scheme is UK only, so it's very much more focused. To be eligible to use the schemes then for VGTR, you had 25% of core expenditure UK or EEA. So core expenditure is very specific expenditures. I think it's on the next slide. In fact, very specific expenditures on the game itself, the game development itself. For the VGEC, it's 10% of core expenditure has to be UK. So it's a little bit freer. Type of costs, as mentioned, coming up next, core production costs only. And VGTR worked as a tax relief. So you would get a credit against tax, so up to the 25% corporation tax rate. And it was an extra deduction. And then if you made a loss, you could claim that back. VGEC, the expenditure credit, works slightly differently. That is not doesn't work out as a directly against cost. It's like an extra expense. So we say it goes above the line, which means that it comes off your profits before they are then taxed or increases your loss. And then it is in itself taxed. So if you're in a taxable position, you receive this credit back from HMRC, that is in itself taxed. So if you're being taxed corporation tax at the top rate, it ends up being about 25.5% relief. So 25% tax on a 34% credit. Hopefully that makes some sense. Next slide, please. So there we go. Core expenditure then is expenditure specifically on designing, producing and testing the game. So costs that we put up there, examples, salaries of your development staff, software costs that relate to the actual game design production itself, subcontracted costs as well, with a caveat on that it is restricted, and story rights costs for producing the game. Costs then that are not allowable are ones before you're in the actual process of designing and producing the game. So concept design is not actually an allowable cost for these reliefs, as you have to have a kind of a project pretty well mapped out before you start claiming these reliefs. Debugging costs and post-release maintenance, they're just maintenance costs. They're not to do with designing and producing the game. And marketing, advertising, distribution, again, they're kind of after what these tax reliefs are aiming at. So that's, you've already got now a product. Next slide, please. Okay, so actually, can we go back one slide? Sorry, Andrew, I've forgotten how many slides we had. Thank you so much. So just wanted to add a couple of extra things on there then. So with these two reliefs, both of them require passing also a cultural test. So the game itself has to be certified as British, and this is actually by the British Film Institute, because it's the same tests that they use for film tax reliefs as well. Very similar kind of relief that they've designed, HMRC has designed. So when we say it has to be certified as British, it has to meet 16 out of 31 criteria, so over half of the criteria that the British Film Institute has elected. And they are cultural, such as the settings. The game has to either be set in the UK, the characters have to be UK, the dialogue has to be in English or one of the indigenous languages. It has to make some kind of cultural contribution, so maybe about British heritage, British creativity, or British diversity. It can be, and then the game production itself can be British, as in the activity is taking place in the UK, and that can be design, story, music and audio recordings, or the personnel certain personnel have to be British, and those are all criteria that go towards making it certified British. Thank you, Andrew. Sorry, just wanted to add that bit in there. So those to the VGTR and the VGEC are specific video games related tax reliefs. But if we take a step outwards, there are other tax reliefs available. Specifically, this one's the R&D, research and development tax relief. Now, if you are entitled to R&D expenditure credit, that will actually override your video games credit. So research and development expenditure credit will override video games tax relief. But if you've made a video games tax relief claim, you can't claim small and medium R&D relief. So the two do interact with each other sometimes in slightly funny ways. So if you think you can do both, it is worth just having a chat about that. Anyway, so jumping into research and development, this tax relief is specifically for innovations, technology and science innovations. And so obviously in video game design, you certainly could be doing some kind of technological innovation as part of your designing process. And it has to be part of a specific project. And as I said, science and technology, it doesn't include arts, humanities, and social sciences. It's pretty much, it's the more harder science kind of area. Thank you. So yeah, as mentioned, you may have to create something innovative whilst making the game. So I think we may have specifics on this, but you have to.
Yeah, shall I jump on, because it was my client, which is why this slide even exists.
I think the next slide kind of gives you the
Yeah.
actual definition of R&D. But yeah, if you'd like to take over, Andrew, you please go for it.
Yeah, so everyone will see on the previous slide, it says no arts and humanities. Well, you're probably thinking, well, why are you bothering? Well, there are occasions where a gaming studio is building something such as an algorithm. The example I have is one of my clients who was building a model. It was a simulation game, and they successfully argued with HMRC that this was furthering and advancing the field. And I can't say too much more about the client because otherwise it would give away who they are. But ultimately there was enough of a constructive argument that what they were doing wasn't just gaming. It wasn't just building a game, but it was a scientific advance. And so there is the opportunity, particularly if you're not a studio, because I know there'll be some other gaming sector companies here that aren't studios, that what you're doing may actually fit the definition of R&D. What I will say is this is a huge area of competition with HMRC, as there has been such a large amount of onerous and sort of fraudulent activity in the sector. So no matter what we sort of say about this, you need to get advice that's specific to what you're thinking could or could not be R&D. And it is a very lucrative thing if it's done correctly, but it is now, I think there's sort of one in 5 or 1 in 6 claims are now actually checked. So it's likely someone will look at your claim if you make one. So getting it right is really important, as there are many startups that have ended up falling foul of poorly drafted claims, which have come back to haunt them in the future. But yeah, sorry, Sarah, I've jumped in.
No, absolutely. my example was to do with graphics as well. So it was specifically to do with the technology behind the graphics. So it certainly can be arts related, but it has to be some kind of technological advance. So I've got two questions have just jumped in, so I'll quickly deal with those. The first one came and says, are these available to solo developers or do you need to have employees? Guessing that is this for the video games or R&D? In both cases, you don't need to have employees. There are employee limits, so you can't be sorry, that's for later on. Yeah, you don't have to have employees to use these, as one of the costs that you claim, are salaries for sure. But if you are a solo developer doing a video game, yeah, absolutely you can claim. If you are a solo developer and you think that what you were doing counts as research and development, again, yeah, look into it. It is definitely possible. And the other question, does research into the use of AI count? Does research into the use of AI count?
I assume you mean for research and development tax credits. You would need it needs to be an advance in the use of AI. So you'd need to be, if you were researching and developing a new method of using AI, and that led to something that furthered the sector, then that might be, I'm going to caveat everything I say because R&D is such a minefield, but that could be, yes, could be.
Yeah,
But the thing is with an R&D tax claim is you now have to supply so much additional information into, okay, who's working on it? Are they a competent, and I think this is actually in the slides, that it needs, we can't just, off of one sentence say yes, but it potentially is possibly the answer there.
Yeah, I mean, if you were shopping between AIs and just researching which one might be best for you to use, that's not really going to cut it. But if, as Andrew says, if what you're doing is researching the use of AI in doing something innovative with it, then yeah, certainly potentially something to look into.
Certainly, potentially. God, we'll get off the fence at some point, but this is what HMRC have done to us all.
Yes, yeah. There's been a lot of HMRC pushback on R&D claims. However, they have said that the number of claims has dropped below what they'd expect this year, and they are still encouraging people, if they think they have an R&D project, to still make a claim. If they think they have, then don't be put off, which is a very interesting environment to be in at the moment. Okay,
Next
and
slide.
we did just say remembering concept costs. So yeah, before you start, so under the video games tax relief credit, video games expenditure credit, sorry, and tax relief, you can't claim your concept costs. You have to actually be in a project at that point. It has to be production and design. They could potentially be claimable under R&D. So as I said, there is a bit of a interplay between these schemes, between the R&D schemes and the video game schemes. Yeah, thanks, Andrew. Okay, this was the one I was thinking of. So research and development, HMRC have set out very specifically what they think counts. And they say the project has to be advancing the overall field that you're working in. Not just advancing your business knowledge. It has to be an actual advance of the overall knowledge of the sector. It has to overcome a scientific or technological uncertainty. So you have to be working towards something new and innovative. It can't be something that you already know or that someone else in the sector knows. You have to try to overcome this scientific or technological uncertainty. And I'm so sorry about the language. This is HMRC language. So you have to be working to seeing if you can make this uncertainty better. So something that you don't know if it's possible to do. You'll need to illustrate how you've tried, including successes and failures. You can get R&D for failing, as long as you've been working towards something that looked feasible. And it couldn't be easily worked out by a professional. Again, it has to be something that the overall sector has not been able to do, and you're going to find some new and innovative way to do it. Okay, so that's the R&D, a quick whistle-stop tour through the R&D schemes.
Before we jump on, can I just say, anyone who has any questions on R&D, it is recommended that if you either speak to your accountant or if you want specific advice, you can come to us or someone else. It's an area that's super contested at the moment. And so yeah, we give disclaimers, but just be aware of how hotly contested it is.
This is how you make an accountancy partner nervous. Yeah, so the third area I said I'd quickly mention are share schemes. So as I said, these are specifically for the investment side. So these are to do with getting investment into the company and the kind of tax reliefs that are available to make that more attractive. Because some kind of startup is inherently quite risky. So the two schemes that I'm going to quickly talk about are Seed EIS, SEIS, Seed EIS, which I've just realized still using the acronym, Seed Enterprise Investment Scheme, and the EIS is the Enterprise Investment Scheme. So the Seed scheme is for new and small companies. New is less than 3 years old, small is fewer than 25 employees, and these small companies can raise up to £250,000 through this scheme. And what makes it attractive is that the investor who puts in the money, they can get up to 50% of income of their investment back as income tax relief immediately. And if the company goes very successfully all the way through to a sale, or this investor gets into a position where they can sell the shares either back to the company or onwards, they get tax relief on that as well. So it's the tax factors that make it very attractive. The EIS is for slightly less new and slightly less small companies. So these are for the slightly larger, slightly later investments. The company can be up to 7 years old or 7 years from its first sale. And it can have up to 250 employees at this point. So yeah, significantly less small. A company can raise up to £5 million through the EIS scheme. It can be more if it's a knowledge-intensive company. And investors get up to 30% of income tax relief immediately, and then tax relief on the sale of the shares as well. Next slide, please. Oh, okay. I thought I'd put an extra one in there. Yeah, so the only extra things I would say then are you must, under the CDIS scheme, you must have spent the money within 3 years. Under the EIS scheme, you have to have spent it within 2 years. And it's not to buy another trade. It has to be on the actual project, some kind of project. And you actually have to prove to HMRC that you are risky as a company to comply. So there we go. It's an interesting kind of scenario, these share schemes. Yeah, hopefully that was a good introduction to those ones. Any
Well,
questions?
thank you very much, Sarah. That was really, really interesting. I think there's an awful lot to consider there. I think I mean it is there's a bit of complexity involved, but obviously things like VGEC and VGTR are designed specifically with games business in mind. I suppose we'll welcome sort of questions from the audience, but I wondered, do you have any sort of thoughts on sort of the sort of lag time between sort of getting these various types of sort of funding in through these mechanisms? Is it something that's sort of going to take a year, 6 months, or how does that work?
Yeah, I didn't mention that, did I? So the actual claim is made through the company corporation tax return. So obviously you finish your period and then you make the claim when you report for after the end of that period. So that can therefore take that bit of time. So you get it in after the end of the period. So the sooner that you submit it, obviously, the sooner you are eligible to then get the money back. And it just depends. unfortunately, I've just seen a whole range of timings on that one. If HMRC want to ask questions about it, then or open an inquiry, that can take a lot longer. But some of them come back within, fairly short order. So it is unfortunately, entirely up to HMRC. And then on the investment schemes, obviously, if you're selling the shares, you get money in immediately. The shares actually have to be paid up, but you do apply to HMRC in advance for confirmation that this. Well, you don't have to, but if you apply in advance to HMRC, they'll give you confirmation that they. From the sounds of what you're describing, it probably will be eligible, and then you can show that to the investor. So you have that up front, show it to the investor, they put the money in, and then it is, I believe, is it 3 months or 6 months before you can then get a certificate for the investor. I think might be 6 months. So that's kind of the timings there. So you've already got the money in, it's just then getting the certificate to the investor so they can claim the tax relief, and that's done through their self-assessment tax return.
Right, there was another question which I'll try and handle because I was trying to work out exactly. So, does the relief still apply to growth guarantee scheme for an investor and Deb, as it's government backed up to 70% for the I'm guessing that's the SEIS and EIS. Sorry, by the growth guarantee scheme, do you mean the loans that it sort of replaced the C-bill as a sort of funding opportunity for early stage businesses? Yes, sorry, after COVID, yeah. So I think this is a really new question that I've not seen before. So I think we might actually have to get back to you on it, but one being debt and the other being equity, unless there's something which Sarah can nudge me on around state aid.
Yeah, I was
IS.
going to say that might be where we're going with this. So the CDIS, you have to watch out for de minimis state aid. But that's a very specific amount of state aid. Oh, they cover the investor.
I thought it's a government-backed loan for the company, no? For the growth scheme? The 705 the 70%, yeah. So the government assistance is to the company, but if
I see.
the
I think
loan
he's saying
fails, yeah.
if the company fails, the investor is kind of insured for up to 70% of what they've put in.
I'm not too familiar with how the loans particularly. Yeah, I understand the sort of idea of what they're meant to do. I haven't actually seen one fail. Is the honest. I think if you want to send the specifics, we can deal with that offline because I think that's quite a challenging one for us to answer right now.
Yeah, I'm afraid I don't know the conditions for the growth guarantee scheme off the top of my head. So
My guess would be because the EIS and SIS is for the investor. It's really whether the company still qualifies because it's technically had state aid would be my guess. But I think we'd need to look into the specifics to give you advice on that.
yeah, I'd have to check if it's de minimis as well, because technically the video game tax relief schemes and the R&D schemes are state aid, but they're not de minimis state aid, so they do not interfere with the EIS and the CDIS. So it may be a similar case, but it may not. We'd have to look at the exact conditions on the other scheme to see if they interact.
Good question. No, that's an interesting one. We like new ones. They always make us look a little bit stupid if we don't know the answer, but it's an interesting one.
No, it's really really good. I think just shows we're at the cutting edge, right? So fantastic stuff. Right. Do I don't. There's been some new sort of VGEC proposals from Luke Martin Brown. I don't. Maybe this is a little bit too cutting edge. I don't know if you've had a chance to sort of review those.
No, but I certainly will now that I've seen that question. So I haven't seen it. No. Yeah.
I'm afraid I was in a 5-hour certification exam yesterday, so I am also have not been keeping up with the news.
That's absolutely fine. Well, I'm sure people can reach out to you afterwards. I think your details are on the Eventbrite and everything. So yeah, fantastic stuff, guys. So thank you so much for your time today. I really appreciate it. I suppose if anyone's got any other questions, they can sort of follow up with you afterwards. But yeah, I think we can draw things to a conclusion there. Sounds like a plan.
Brilliant. Thank you all very much for having us.